Sorry, Lola's trying to get in, so she should be coming in a minute.
Wonderful. Thank you. Trying to see who else replied that they were attending. You know, Blake said he was unable to attend. I thought Brad was attending and I thought Lucy was attending, but I don't see Lucy's name even on the list. I see we have Matt in attendance today. Hi, Matt.
Good afternoon, everybody.
We have a pretty brief agenda today. We have BTC to go through the quarterly information, just kind of a recap and assessment of annual meeting, talk about what went right, what went wrong, and talk about the elections, and then talk about future meetings, kind of a cadence and schedule of future meetings. Right now we're meeting monthly, and there's been some people who have expressed that they might be interested in changing that cadence. Barb, Melissa, Rich. I'm going to give it about another minute and then we'll just go ahead and get started with the review. John, Alan, Jeff, I don't know who's going to start, but whoever is going to start, I'll let you guys take it away and start with our financials.
All right.
All right, I'll take it away. This is Alan, and can everybody hear me? Is my microphone on? Looks like it is. Okay, great. So we will go through the quarterly investment report as usual. I'll share my screen. I'll start off, and then John and Jeff will join with comments. So let's see here. See. Bear with me a second. I gotta. Just a second. What? Computer problems today. Okay, let me see here.
We can relate. We haven't had any computer problems as a district, so it's really we're sympathetic.
Well, it's not. They aren't hacking problems, thankfully. So it's just me. So can everybody see the report?
Yes.
Okay, great. So as usual, we'll start on the compliance page, and this page highlights the most significant guidelines that are specified in the investment policy statement with respect to how we are to manage the portfolio. Just starting at the top with cash, the current allocation, which is shown in the right column, is 1.9%, or excuse me, anytime I say current, I mean September 30th. And these numbers haven't changed a lot in the last 6 weeks. So, and if they have, I'll let you know, but they have not in 99% of the cases here. So current allocation is 1.9%. That's within the range specified in the investment policy statement of 0 to 10%. Fixed income, the weight is 73.7% as of September 30th. The guidelines are 60 to 90%. So we're right in the, near the middle of investment grade, 0 to 100%, and we're 60% there. Triple B, 13.5%. So by far the majority of the fixed income portfolio is investment grade. And there's a little bit of below investment grade, but it's less than 1%. Preferred stock, 0.3%. Moving on to equity below that, we were at 24.3%. Sorry, that's me. On equity, we were at 24.3% as of September 30th. The range is the range that's allowed is 10% to 30%. And so in general, as I mentioned before, this is where the volatility in the portfolio, for the most part, lies. Fixed income can be volatile, but fixed equity is where the most volatility occurs and is the highest risk asset class in the portfolio. U.S. large cap is an anchor, and specifically these are large cap value stocks rather than growth. Value is a little bit less volatile than growth, so we are tilting value. We're also doing that for the added income. For example, the dividend yield is near 3%. I believe it's about 2.8% currently. John will touch on that. We have that in some of the detail in the following pages. But lower volatility in value versus growth, and then also higher dividend in value versus growth stocks. So those are some of the key characteristics of that 17% that's in large cap. Small cap, we've got a small allocation, 2.9%, and that's within the guidelines, 0 to 10. Real estate and international stocks round out the overall equity allocation. All of the fixed income and the fixed income weights, the equity weights, and the cash weight are in compliance with the guidelines, the minimum and maximum guidelines specified in the investment policy statement. So there's no need to adjust the asset allocation to bring it into compliance. It's already in compliance, and if we got close to any of the maximum or minimum guidelines, we would certainly be having a conversation about it and be making adjustments accordingly before there was a significant violation of the guidelines. To finish the points on this slide, other limitations in the bottom third of the page, or bottom third of the slide, investment in any one corporation. As of September 30th, it was 1.8%. That's a combination of Walmart stock and Walmart bonds. So just slightly under that 2% maximum. The mortgage back, etc. Combined exposure is 9.1% under the 30 maximum. Corporate bonds, municipal bonds, government and agency bonds, and non-income producing assets. All of those categories are in compliance with the guidelines specified in the investment policy statement. So no issues to note there. Moving on to the next page. We have the allocation as of September 30th in the upper left. Specifically, this table lists the market values for each of the major asset classes as well as the market values. We just touched on many of these market values. The percentages in each of these asset classes as of September 30th. So I won't repeat, but in general, the maximum for equity, I guess I will repeat a little bit. The maximum for equity is 30%, we're at 24%, and then conversely, the combination of cash and fixed income, we're at about 76%. So those are the key details. And then the bar chart in the lower left summarizes the size of each of the components in the asset allocation as of September 30th for each of the years that are labeled at the bottom of each of the bars. So it's September 30th of 2023. I'll use my cursor, focusing on this right here. The navy blue is large cap US stocks. That's the 17%. The remainder, the gray, most of the remainder of the gray is fixed income, and then a little bit in each of the asset classes. So not only are we looking for the size of the more volatile asset classes for any significant movement in the size, but also just looking left to right for consistency. And we see a lot of consistency in the size of that large cap allocation as well as the other equity allocations. So that tells us that the risk of the portfolio is fairly consistent in a general sense. Any thoughts or questions before I pass it off for more points? Okay, we'll keep moving here. John will take us through performance with a focus on the table in the bottom half of the page.
Thanks, Alan. So taking a look at the performance information on page 4, the first series of lines in the information across the bottom half of the page is the total fund. So you can see for the 3 months ending September 30th, the total return was a minus 2.5%. This is compared to its benchmark, which was actually down a little over 3%. And as you scroll across, you can see on a year-to-date basis, which obviously this is calendar year-to-date, not your fiscal year-to-date, because we're looking at that 9 months as of September 30th. Your portfolio had a positive return of 0.9% basically relative to the benchmark of a -1. And for the last year, you can see your portfolio return 5.9% versus your benchmark of 3.2%. One of the nice things that has happened this year with regard to increases in interest rates, any money that you have or in the money market fund is earning a much higher yield than it has for the last several years, as money market yields have been hovering around that 5% level. So it's been very good to see. You can see the 1-year return for cash and equivalents is 4.5%. It's been some time since we've seen that type of return from a money market type investment. Also, on the quarter for fixed income down somewhat. We have seen, as I mentioned just a moment ago, rates go up, and that has been not just for shorter maturities, but for longer maturities as well. They've since this time somewhat come down somewhat, which is translated into some better performance for fixed income. But as of September 30th, the return for fixed income was a minus 2.25%. But as you can see, that was about a full percentage point better than the benchmark, the Bloomberg US Aggregate Bond Index. For the year where bond market has had a negative return, your portfolio in terms of its bonds have had a positive return. And for the last year, you can see that return of 2.91% for your fixed income versus the benchmark at 0.64. So substantial outperformance relative to benchmark. And most importantly, in that year to date, you're seeing a positive return relative to the negative for the benchmark. Just scrolling down to the equities, and I don't mean to purposely skip tax exempt fixed income, but for the most part, those are, and we've reviewed this in prior meetings, those are taxable munis. Our system, because they are municipal bonds, classifies them as tax exempt, but virtually all of them are actually taxable. There was a program that came out of the financial crisis back in 2008, 2009 called Build America Bonds, which allowed municipalities to issue bonds which were taxable versus the typical status of where they would be issuing tax exempt bonds. So for the purposes of classification, they still get lumped into tax exempt fixed income, but they are taxable. And you can see it only represents 1 million out of the entire 172 million in terms of the value of the portfolio. Scrolling down to U.S. equities, 3 months down just under 3% at minus 2.9 versus the benchmark of minus 2.6. Was a tougher quarter for financial assets overall, as you saw, including the fixed income. For the year to date, performance minus 0.18 versus the benchmark of minus 0.57, and then for the 1 year, 14.2% versus the benchmark at 12.8. So when you take a look at that September 30 time frame, we did have some good performance in the early part of the year, obviously, and then we did see some weakening in the third quarter. But as you can also see in that 1 year number, still a very nice return. The foreign equities, a little more negative return in the shorter term time periods in terms of the 3 months. But then when you get to the year to date, actually up 10%. And that looks very favorable compared to its benchmark of 7.08. And then for the 1 year, 29.7% for the foreign equities versus a benchmark of 25.65. So some additive performance from the equity component of the portfolio, particularly when you're looking at that year to date and 1 year performance. Is there any question about the investment performance before I turn it over to Jeff to talk about the fixed income holdings in the portfolio? Okay, hearing none, I will turn it over to Jeff to review the characteristics of your fixed income portfolio.
Thank you very much, John. One of the good news factors is since that quarter end number, as you saw in the fixed income area, you saw a negative return. The benchmark has actually returned to a positive return in the last few days. The overall benchmark is up 0.4%. So we're suspecting that the portfolio is as well. It's generating again on the positive side of the blotter. Essentially, we are seeing positive returns out of fixed income, but small, but ahead of the benchmark still. And if we return back to the characteristics page, thank you very much, Alan. You can see the overall yield. If we were to sell the bond portfolio today, it's yielding about 5.91%. relative to the benchmark 5.39%. So part of this is that you have assets within the portfolio that are higher yielding, and as a result, they are generating that excess return that you're seeing within the portfolio. Overall average credit quality, extremely strong, A1 on average. And you can see down below, there are very high credit quality. Only 18.7% is in that triple B category versus 12.4%. Again, this is because of the higher concentration in corporate bonds. Generally, they are going to be in that single A and triple B space overall. The one below investment grade bond that is in there, that's a Ford Motor Corp. It matures in 2026. We feel very comfortable with that bond. I don't think Ford Motor is going to go anywhere. They've got their contract signed. So I think they're on a path to continue to make those bond payments. That's been below investment grade for some time. We felt very comfortable holding that bond and carrying that in the portfolio. Back at top, average maturity 8.72 years versus 8.49, and then a slightly lower than average effective duration. We have a just under a 6. The benchmark is 6.15. And effective duration is a measure of interest rate risk. How risky is the bond manager, the manager doing here? How much risk are they taking within the portfolio for interest rates? And our number is below average, so therefore there is slightly lower risk. So on a risk return basis, very effective, what we call Sharpe ratio, very good risk return relationship out of the bond portfolio in general. Overall, what is the portfolio actually earning? The portfolio is actually earning a return about 4.5% currently when you add up when we bought things and what they're what's called accretion of an amortization of the principal components. A very good return, actually, much higher than the benchmark itself. So all in all, good quality, good performance so far. What we are continuing to look at is making some shifts within the portfolio as mortgage-backed securities, which we are currently underweight on a relative basis, as their outlook is that they may perform better over the next year. So we may be making some changes within the portfolio related to that. So thank you very much for your time, and I'll turn it back to John.
Okay, thank you, Jeff. We'll turn to page 6 now and start taking a look at the equity holdings in the portfolio. As Alan mentioned earlier, the most significant exposure you have in terms of equities are in large cap value stocks. These are domestic stocks, and once again, as he alluded to, known for being a little less volatile and more income oriented. And we have made a conscious decision over the last few years to focus most of the exposure on the equity side to this type of stock because as interest rates came down, it was harder and harder to generate the necessary income from fixed income. So we wanted to add on the equity side stocks that would complement the bonds in terms of income production. And you can see when you take a look at the upper left-hand corner, just a few lines down, you see dividend yield. As of September 30th, that was 2.97%. The benchmark we use for this particular portion for the portfolio was at 2.65%. So right around 3% just in terms of income that's being generated by the stocks in this segment of the portfolio. And that's significantly higher than the stock market overall, which is actually less than 2% when you look at broad market indices. So just kind of highlighting again in terms of some of the characteristics of this strategy in that upper left-hand corner. We focus on this strategy in terms of having a lower than benchmark valuation. And for purposes of that, we use the price earnings ratio, which is the price of a stock relative to its earnings. And this is done on an aggregate portfolio level. You can see as of 9/30, it was 14.0 versus the benchmark at 16.5. So we're getting a lower valuation, a higher level of income. Those are the two parameters we really focus on in this strategy to keep a higher level of stability while generating that extra cash flow relative to the broad market averages. Directly below that, we have the sector allocation, which allows you to see how the various economic sectors are represented in the portfolio versus the benchmark. When you take a look, you can see there's not a lot of deviation between some of the sectors and the benchmark weight. Consumer staples would be one at 12.3% versus the benchmark at 10.6. Consumer discretionary lower at 2.8 versus the benchmark at 6.3. Part of that with those two sectors is that we did have a company that was reclassified recently, which is Target Corp. Target historically had been considered a consumer discretionary company. And with its evolution over the last few years, doing more things like groceries, they were redefined as a consumer staple company. So over the last couple of months, we've seen that holding shift from being discretionary to a staple. And that's what accounts for a significant amount of that differentiation between the portfolio and the benchmark in terms of those two sectors. In the lower right, you can see the top 10 holdings, and with the larger strategies, larger company strategies, you're typically going to see some names that you're familiar with, very familiar with: Walmart, Procter & Gamble, Johnson & Johnson, JP Morgan, Exxon, Cisco Systems, etc. All very familiar to all of us as consumers. And then directly above that is a pie chart showing the allocation across these various sectors, so you can get a sense of the relative weighting across the various sectors, in terms of financials being the largest weighting, healthcare being the next largest, information technologies, at just under 13%. So it gives you a visual representation of that. With that, we'll turn to page 7 and take a look at the small cap strategy. So as you know, over the last couple of years, we've incorporated some additional strategies beyond the large cap value stocks to try and enhance return and or income in the portfolio. With the small cap strategy, it's more a focus on providing some more growth potential in terms of the equity portion of the portfolio. And once again, highlighting those characteristics in the upper left-hand corner, you can see much smaller in terms of average market capitalization at about 4.4 billion. With those large cap stocks, it was about 295 billion in terms of average market capitalization. But once again, we do see where that price earnings ratio is less than the benchmark. That's a key metric across all our strategies. We do try to focus on keeping that at or below the benchmark to have a lower level of volatility over time. And the dividend yield here, not as great, 1.5%, virtually equal to the benchmark. And as I said, we're focusing this on a little more in terms of growth potential versus income generation. Taking a look at the allocation in terms of the sector allocation in the lower left corner, once again, not huge deviation for the most part across those sectors. And then as you scroll over to the lower right corner, names typically not nearly as familiar to us as consumers and market observers, but good high quality companies across the board that comprise the top 10 list and the portfolio overall. Moving to page 8, we have international equities. And so we do have some non-US exposure in the portfolio as well. And that is represented in this segment, the international equity component. And this does have a nice dividend yield at 3%. Its benchmark is at 320, so pretty much right in line there. So good income being generated from this segment of the portfolio as well. You can see once again that price earnings ratio coming in less than the benchmark. And obviously a much larger market capitalization relative to the small caps, which were between 4 and 5 billion on average. Here we have an average of a little over 100 billion. One of the characteristics here, similar to the value strategy, financials do make up a big portion of this strategy, as outside the US, they comprise a bigger part of the overall market capitalization throughout the world, once again, outside the US. And as you see, information technology is a relatively small part of it, as opposed to what we see here in the US, which is much more significant in terms of technology. Moving over to the right, the top 10 holdings, still a few names that are very familiar to us as Americans, even though they're domiciled outside the US: Unilever, Nestle, etc. So big high quality companies generating some nice income, as well as some prospective potential total return. And you saw how well those international equities had performed when we looked at the performance summary a few moments ago. And then lastly is the real estate holdings. You know, real estate is actually one of those 11 sectors that comprise the overall equity market, whether you're looking at domestic, international, large or small. But we carved out a portion of the portfolio to focus exclusively on real estate, primarily, well, pretty much exclusively because of the income. Upper left-hand corner, those characteristics, you can see the dividend yield, a little over 6% as of September 30. So very nice yield coming off these. However, real estate has suffered a little bit this year as interest rates have risen. So from a total return perspective, the price depreciation in the value of the holdings has offset the income to a large degree. But once again, you are getting that additional cash flow from the income, and given the decline in the prices, could be presenting us with an opportunity to at some point add some exposure to it at some better levels, and once again enhancing the portfolio overall from an income perspective. So once again, over in the lower right corner, you can see the top 10 holdings. Not nearly so familiar as what we saw with some of the other strategies, but very good quality companies. And once again, most importantly, generating that high level of income, which we've pursued over the last few years as interest rates decline dramatically. It's been very nice to see the interest rate increase from an income perspective, and the yield on your bonds, the yield on money market funds. So that's a very positive development for the plan. With that, I will conclude and open it up to any questions you might have.
I have one question. This is Barb. You know, we've talked many times about changing the ratio from 70-30 to 60-40. And when you look at this, and the equities came out, you know, with a very good yield when you look at the 12 months. Can you remind me again, what are the risks of, or how would you see the risks of changing that? And I guess the second part of that question is that, you know, if we voted to do the 60-40 mix, I mean, you certainly don't have to do that 40, but if you look at things right now, would you say that going up to 40% would benefit the plan?
Well, you know, it's actually interesting because that's the topic of next month's meeting. Is our plan is to review the asset allocation, look at alternative mixes, and share some information in regard to that.
Okay.
John and I, this is Alan, excuse me, John and I have talked about this quite a bit, and I talked a little bit about this at the annual meeting, and one point that I didn't bring out maybe enough, but it's just an estimate anyway, and that is the notion that, so the funding status being at 88%, I believe, as of, I don't know if that was June 30th. It must have been June 30th, Kathy,
Yeah.
I don't remember, but if we hold all the factors constant and say, okay, if the equity market and our current weight goes back to the all-time high on the S&P 500, for example, that would take just a rough estimate, no guarantees, anything like that. That would take the funding status of the plan pretty close to back to 100% all by itself. So that's one factor. We certainly wouldn't want to write that in stone because, again, it's the equity market, and the equity market is very unpredictable. But that would suggest, Barb, that increasing the equity weight isn't necessary to increase the funding status back to 100%. So in essence, another way to look at this is increasing the equity weight would just simply introduce more risk.
Okay.
Certainly it might take, if we went to 40% equity, sure, it might take the funding status above 100%, but is that necessary?
Okay.
So, you know, Lucy and Brad might have more to say about that and I don't want to step on their toes about funding status, because I'm certainly not an expert on it. It's not what we do.
Yeah,
But in general, if you get the growth out of the equity component of the allocation, the 30% allocation or the maximum of 30% should support the funding status pretty well, just right where it's at. And that would be the thing, that would be what we would communicate to the board if they had questions about, talk to us about the risk inherent in going from 30 to 40% in equities. It increases the risk, yes. It's a bit difficult to quantify. Estimates can be made, but the general concept is it's probably not necessary in order to take the funding status back to even or 100%. Second thing that supports the equity weight right where it is just the fact that fixed income yields have gone up significantly, dramatically, in fact, over the last 24 months. So, Jeff touched on it in terms of what yields are now. If we sold the entire fixed income allocation at this point, the yield in doing so would be 5.9%. And I know I don't want to speak for Jeff. Jeff can speak on this, but any new bonds that are being purchased, I believe the yield is, depending on the maturity and the quality, but the yield is in the neighborhood of 6% or more.
wow.
And it's
Yeah.
been 15 years since, at least
We've
15
seen that.
years, since, pardon me, 15 years since we've purchased bonds in that neighborhood, unless they've been extremely long maturity bonds. So does that help, Barb? I know it's
It
a lot
does.
to
Yeah.
say, but
Yep.
There are
Thank you.
factors that suggest to leave the allocation where it's at, and we'll provide more detail in the next meeting.
Okay, great. Thank you.
Anything else before we go? Because the only thing I had was to mention that we will go over that analysis in detail at the next meeting.
Great. Thank you, guys. I appreciate that. And thanks, Barb, for asking the question. It gets us all thinking for next month's meeting. So thank you.
All right, thanks, everybody. See you
Thank
next month.
you.
Thank you.
Bye-bye.
Thanks. Okay, we just have a couple things to cover after they've logged off. We had our annual meeting a little over a month ago now. Just wanted to talk to you guys about thoughts on annual meeting. I think I'm feeling a little uneasy and a little frustrated on annual meeting, feeling like participants aren't getting out of annual meeting what I feel like they should get out of annual meeting. And I feel like it's more of just a regurgitation of some information. It doesn't seem to be interactive at all. And I'm wanting to know from you guys' perspective as plan members, what can we be doing differently to enhance annual meeting to make it more valuable to members?
Well, Kathy, let me ask you, what is it that you would like? What do you think would be better than what we're doing now? Like, what's missing?
I just feel like it's very one-sided. We give information. There's not a lot of dialogue. No one expresses any questions or really, I feel like people are kind of disinterested in the information. And the only time we get any participation in annual meeting, or I feel like people are interested, is when we have something controversial going on. And I'd like people to have just more ownership in their plan. I'm not sure how to achieve it. I feel like, the format of it right now is difficult too. We didn't have that many people present in person. The individuals present online, there were some technology difficulties and they couldn't ask questions from online. Last year, the online didn't work very well either. In the past, when they were in person, I felt like people got together, came in, talked amongst each other. It felt more community-wise than it does right now. It feels, I don't know, just very formal and not very productive from my lens. And I want you guys to feel like, oh, I'm going to annual meeting and I'm going to get something out of it versus, oh, I have to go to annual meeting and sit in a chair and take this in and then leave.
So I guess what I'm thinking about when I'm hearing you talk is if we wanted people to be more interactive, basically a lot of times they don't say anything because they don't know what to say. They don't know how to formulate the questions they may have. But we know what questions they probably will have because we, have spent all this time in all these meetings coming up with it. So we could, do like some of our classroom strategies, put together a Kahoot and do a little quiz. What do you think? And then if they don't understand things as we go through it, you know, some little fun game, you know, which of these would define your benefits, you know, whatever. Just to see if people understand enough about their plan that they can ask intelligent questions, or if they don't understand enough about their plan to ask an intelligent question, they can start asking questions and they at least have a topic. A lot of times people don't even know where to start. They're just like, just tell me everything's going to be okay. That's really what they want to know, because finance tends to be something that's too hard for a lot of people to get their heads around. That would be my thought. So, I mean, we could, you know, play a little quiz show game or something else to get people, just to see if they understand, you know, some of those strategies that we use in the classroom to get people to find out what people know or don't know, like a formative assessment. What do you know about your, you know, retirement plan? and and that could generate the kind of conversations you're asking for, Kathy. And also, I mean, you hear those questions all the time. You know what the top 10 questions are going to be, right? Like people are emailing you constantly about that. So we could put that into a fun format, and I bet people would really go for it.
I like that. And I will definitely lean on you individuals with teaching experience. That is not my forte, but you've got it. And I will lean on that. But I think that's great ideas, because I really do want to involve people. And I feel like when I was sitting there this year in particular, looking out at the crowd, it was just like, I'm like, come on, it looks like I'm presenting with a bunch of stuffed animals out there. Come on, I just needed something. And I felt bad. I felt like we're falling short of what our members deserve.
Well, I thought it was interesting, Kathy, because between last year and this year, last year there was a lot of people there, and this year there was probably less than 12. So I thought that was I thought that was strange. Because when it was at Kurt's, there were just tons of people. So I don't know.
I had some feedback that they didn't like the location.
Oh, really?
They don't like Central Campus because they feel like it's difficult to get to. And I
Okay.
did have a couple individuals that I helped get to the room. Some of our older individuals really struggled to get
Sure.
to the spot.
Okay. Well, that was good feedback.
But that was the only place that we could hold it, that we could do the live stream. So it was
Yeah.
the trade-off of one versus the other. And maybe we do one in person, and then I just don't know. I think we need to work on that for next year. What's the
Sure.
best delivery of it? And I really like Jessica's idea of trying to get them more involved. Any other suggestions? We'll continue to work on that. I'm going to kind of log my questions that I get from DMTRS participants, and have Sherry do that as well. And hopefully that will give us a launching point. The final thing I have is the election results. Barb, I know you have probably had many sleepless nights not knowing if you were reelected or not, and I apologize that this has taken so long to get these results, but I want you all on the edge of your seats now to jump up and down and cheer that Barb has been reelected to serve on the advisory committee. And thank you, Barb, for volunteering to do that. And then also, I would like to welcome Lucy as well as one of our citizen reps. Thank you, Lucy. And we will be submitting those names to the board for approval. The active member vacancy, there was no one that was nominated, and there was one write-in. I've been trying to get a hold of that person, and we have been playing phone tag. I want to see if that person is willing. If they are willing, I will send this committee an email with their name, and then their name will be also included for the approval to the board. Hopefully we can get a full slate here and we can move forward. The final thing on the list was we have been meeting monthly, and I had a couple people come to me and say, now that we're not in the throes of, are we moving to IPERS? Are we doing a 401A? Are we doing a 403B? Are we revamping the plan? Or, all of that we were meeting frequently. Is monthly the right cadence, or should we shift to a quarterly meeting? And if there's a need to meet more frequently, then call a meeting more frequently. Wanted your feedback.
I think the only thing that we had as a standing agenda item for us to consider and advocate for was a continuation of the early retirement option for DMTRS actives. That is really the only thing that we had as an outstanding issue for us to consider as we go forward. But that's certainly something we can do quarterly. I don't know if we need to have a monthly meeting. But I understand during the time that we were trying to make some pretty big decisions and trying to clean up the plan document so it's readable, we needed those monthly meetings, but I don't know if we need those now. I don't know. That's my vote.
Yeah, my vote too. I don't think I would certainly go back to quarterly and then be willing to meet more often if necessary.
I would propose that we meet in December because we've got
Sure.
BTC coming to talk about the investment strategy. And then going forward, we meet January and quarterly from there.
Yeah.
Does that
Sounds
sound
good.
like a good plan?
Yeah.
Okay. We will get that schedule revised. I will plan to send the advisory committee names to the board, let you know if I do have an active member. And again, thank you guys for all serving on this committee and thank you for the work that you do. All right. Have a great evening. Get out there before it's dark. It's beautiful out.
Yes. Thank you all.
Okay. Bye-bye.